Everyone, and welcome to our Friday webinar. First of all, I want to give a little shout out to our friends in Georgia who are listening, and thank you very much for doing that and being on fairly consistently. I'm Terry Horan, and I will moderate this seminar, and we have several experts in the room. But first, let me tell you that our fundamental of the week, and we have 27 of them, is get clear on expectations. Getting clear on expectations means creating clarity and avoiding misunderstandings, discussing things up front. Set expectations for others and for yourself, and ask when you're not clear on what they expect of you. Always ask that extra question. And so we're going to keep our presentation somewhat short today, so you can ask some extra questions if you'd like to do so. Also, I'd like you to know that next week we're going to alternate our time. We're going to change the time to 12 o'clock. So next week's webinar will begin at 12 o'clock. The governor of Ohio called us and said, we've got too many people on the line listening to us, and it's interfering with his messages. So we're going to move off 2 o'clock in deference to the governor and go to 12 o'clock. So I have with me today David Templeton, Managing Principal at Horan Capital Advisors, his loyal assistant, Matt Antonucci, who's a real genius behind the whole team, and also a CFA. Michael Hermes is with us, also a CFA. And Greg Hornschmeyer, who's been in the life insurance business longer than he'd care to remember. So the first, we're going to have some questions afterwards, but at the moment what we're going to talk about are some of the slides that are in front of you. David?
Thanks, Terry. So the S&P 500, we ended March in the S&P, or I'm sorry, ended April and the S&P was up 13%. This follows March, which was down almost 13%. April was actually the best performing month behind January of '87 and October of 1974. All of this has occurred after the market fell almost 34% from around mid-February to almost the end of March. So could there have been some hints that we could have seen a stronger market in April? And we would say there were some potential signs. And what you see on this chart here, it's a sentiment chart for individual investors. That's the green line. We often see that individual investor bullish sentiment, which this line represents, tends to fall to a very low level near market bottoms. So you can see on that chart, those two red circles, the green line has the bullish investor sentiment below 20%. That's an indication potentially that a lot of individual investors are either out of the market or taking some money off the table. The maroon line is the S&P 500, which you can see there, that low bullish sentiment occurred near a market bottom. Well, if you look on the far right-hand side of the chart, that last dot, that is the investor sentiment here, just near term here, near the low in March. You can see the market did have a spike higher before the bullish sentiment fell. Two things need to occur for these sentiment measures to be kind of most actionable. It needs to occur in a declining market, and the bullish sentiment needs to be at a very low level. You can see on the left-hand side of the chart, we had low bullish sentiment, but the market was at a high. And these can be used in the reverse also. High bullish investor sentiment might be a negative. So this is one thing that you can look at when you're looking at potential market, looking forward for the potential market action. So Matt, do you want to touch on some other sentiment measures that we might factor into our strategy?
Absolutely. So on the next slide, the quote at the top from Warren Buffett is extremely applicable to the next sentiment indicator I'll touch on, which is the Fear and Greed Index. And it's an index that CNN publishes. It's a market sentiment measure that takes into account 7 different indicators and assigns a score to it from 0 to 100. So the lower the score, it means that the market's in a fearful mode. Sentiment is fearful. The higher means that we're in a greed mode. The market's in a greedy mode. And so we're showing you the Fear and Greed Index over time at the bottom of the chart, and we're comparing it to the same time period with the S&P 500 at the top. And like David mentioned, sentiment in a contrarian sense is much more relevant at near extremes. And we've highlighted some of the extremes in fear in the market and how they coincide with market action and the dotted blue lines going across the chart here. So you can see that before the markets made bottoms on this chart over the past several years, the Fear and Greed Index was deep into fear territory. And it's contrarian in that when this measures low, it's typically an opportunity for investors to be greedy and take advantage of lower prices. And the most recent dotted blue line on the far right shows the index dipped to the lowest level in 3 years back in March, which just happens to coincide with the market low that we experienced on March 23rd. So you notice just before that happened, the fear and greed index coincided with the market high. I think it's important to note that sentiment works both ways at both extremes. When we're greedy, risk might be, the market might be a little risky or toppy as well. So currently we're sitting in neutral territory, you can see. So it doesn't tell us much about the market direction right now. But again, this chart in total just shows us the contrarian nature of markets and that markets tend to do the opposite of what everyone thinks is going to happen.
Matt, I'd love to ask a question at this point to either you or David, and that is, often we hear on the radio the term the VIX. And what does the VIX and that measurement have to do with market sentiment or investor sentiment or market sentiment?
That is another sentiment measure, and without getting into all the detail how that's calculated, it comes out of the options market, but how investors can look at that in a market where the VIX is rising, that's generally, it's mostly occurring when the stock market is declining. And so if you see the VIX is making a move upward, it could be an indication we're getting into more difficult times for the equity market. And vice versa, as the VIX is falling, which it has been here since the market low, it's a sign that the equity market is going to be improving.
So in early April, the VIX was somewhere around 85, somewhere in there.
Which is a very high level. And it would have been an indication that maximum fear,
trouble waters.
and that's when you invest.
And that's when you invest. That's when you want
Be
to
greedy when others are fearful.
when the VIX is high. So where is the VIX today, David? Or close?
So I'll tell you here in just
Didn't
one.
mean to do that.
It'll take me 1 second to tell you the VIX is at 38. It's up 13 points.
So it's down significantly.
But it's up 13 points and the market's down today.
Yes,
There
right.
you go.
Well, there you have it, folks. The VIX is in. All right. Next slide.
Matt?
So just quickly, we wanted to touch one more time on the amount of fiscal policy that's been pumped into the economic system and just how that relates to sentiment. This goes beyond just the stimulus checks and the PPP loans that we've touched on in the past. And we're showing you this on this slide 5. This is all the fiscal policy programs that have been enacted. And you can see there's 2 columns, the dispersed column and the allocated column. And not all money has been allocated has been dispersed, but you can gather on the right-hand side, the bottom total number, $3.3 trillion. It's a lot. So we want to provide some context to this. When you add up all the fiscal stimulus that's been allocated on this page, the total amount equals more than the GDP contraction that we've had in the economy so far, which is one reason why the market might be acting in the way that it has and the rebound that we've experienced despite the economy still being closed down. We might be temporarily filling a gap within the system, and it's a short-term buoy to investor confidence and investor sentiment within the market.
So it's putting the floor under the market, basically.
Right.
And didn't the Fed chair say this week that he intends to continue to do this as long as possible?
Exactly, whatever it takes.
Whatever it takes.
Those were the words.
Yeah, thank you. So we used the word bazooka about 3 weeks ago, and the bazooka continues to fire.
It's fully loaded. So I think Michael Hermes was going to comment on the next chart.
Michael?
Yeah. So continuing with the whole sentiment theme, as a result of that global market sell-off, many investors are sitting on piles of cash. And as of April 23rd, which is what this chart reflects, there's roughly $4.65 trillion sitting in U.S. money market funds. Even during the most recent financial crisis of 08-09, cash levels didn't even surpass the $4 trillion mark. So we can see from this chart that cash is at a historic level. So although fear and global slowdown has caused these levels of cash, the silver lining to all this is that the chart usually serves, once again, as did the other charts, as a contrarian indicator. So because so many people have sold out of the market, now may be the time to look at some buying opportunities. So as investors begin to regain confidence in the economy, there's a lot of cash that still needs to be put back to work in the markets. Ultimately, this should drive market prices back up. So with that in mind, I'll hand it back to Terry for any Q&A.
Well, we do have a Q&A, Michael, and one of them has to do with the slide that you just presented on number 6. How should individuals holding a high level of cash at this point think about investing any of it or all of it, and where? So money market funds aren't particularly the most attractive vehicle in the world, but maybe I don't want to use up all my dry powder. What do I do?
Right, and I've been getting this question from clients a lot recently. So generally, before anything, we encourage our investors to get together with their advisor to devise some sort of plan as to how they should redeploy that cash. Generally, it's not best to try and time the market by putting all of your cash to work back at once. And instead, we encourage our investors to be mindful of this and slowly dollar cost average back into the market. And by dollar cost averaging, I simply mean putting bits and pieces of the cash back to work over time. And so as to where that money should be redeployed, generally, when markets have been beaten down the way they are, looking at some sort of value type companies might be beneficial for your portfolio, but that is something really that you should get with your advisor to talk about.
Michael, isn't this the perfect time for young people to be using 401k plans, because that is the perfect tool for dollar cost averaging, is it not?
Definitely, and especially if you get some sort of employer match on your money, you should be taking full advantage of that employer match and putting that money to work inside of your employer plan.
Yeah, agreed. It is amazing to see how much cash is sitting on the sidelines. And you said in 2008, 2009, it wasn't as high as it is today?
That's correct. It was it didn't even hit the $4 trillion mark, and so currently it's at about 4.65 trillion sitting in money market funds. So,
Matt Antonucci, we've heard a lot of optimistic statements today. How do we think about sentiment and when we talk about Horan's investment process?
Sentiment it's one of many inputs that we use when we're analyzing and looking at investment opportunities, especially when we're making asset allocation decisions, and that when sentiment's high and we're looking at potentially adding some investments to client accounts, we might be a little bit patient, but vice versa. If sentiment appears to be depressed in an area of the market that we find attractive, we might be that might be encouraging for us, and we might move a little bit quicker there. And I think sentiment's part of we think of investing as an art and a science, and sentiment analysis is part of the art of that. And it's something that we incorporate alongside looking at more fundamental metrics.
Yeah, and I think that's important. It's part of the investment process, maybe on the big picture, but even if you had high sentiment, which would be negative for the market, there might be some stocks or areas that would be attractive that we would still be comfortable investing in, but it's just one variable into the process.
It's another measurement, yeah. David, we've seen some record unemployment rates. At the moment, we seem to be at 30 million people unemployed in the United States. That's remarkable. And how does that play into thoughts on where we're going and where we are?
So yes, record jobless claims, record decline in consumer spending, record decline in industrial production. I mean, all the news is bad. And when all the news is bad, you have to think the market's either at a low, it's an opportunity. You have to think from a contrarian perspective. Maybe it's all priced into the market since it knows all of this bad news. So some of what's happening today is we're looking over the valley, possibly, and looking at the recovery that's going to maybe, we hope, which it should, occur.
Yeah. So even though we have a compliance officer in the room, we're going to ask you to look into your crystal ball for just a minute and say, could the unemployment numbers begin to level off because as we reopen the country in May and June?
Possibly. I'm going to say later than May. I'm going to say June. I think it'll be a slow process getting people back to work. But the retailers are opening up. But there's retailers filing bankruptcy and closing and aren't going to open. I think it's going to be longer than that from fixing the job situation.
Another interesting aspect of this 30 million unemployed is a good percentage of them are making more as unemployment benefits because of this bazooka we've been talking about. than what they were making at work. And so perhaps the consumer, which is 70% of the economy, isn't as impacted, just doesn't have the chance.
No, and that's interesting. We've actually seen the savings rate go up. Partially because of that, and partially because nothing's open, so they can't spend it. So that is true. There may be some, just as there's record levels of cash in the money markets, these consumers maybe have higher cash levels that they're going to be somewhat wanting to spend.
Yeah, if you don't
What
mind
could
me
be-
saying so, you could use some new shirts.
Well, I'll tell you where I got this. Your tailor's not going to be happy.
Open a store, you'll buy one.
Well, I mean, I think there is that pent-up demand because you just can't get it.
Yeah.
Yeah, although Amazon is trying to help us all out.
Yep.
We're going to switch gears for a minute and talk about something that might be more interesting to some of our employers, and that is, Greg, could you sort of discuss the changes that are occurring in the PPP loan forgiveness docs?
Sure, Terry. Thanks. Good afternoon, everyone. Actually, the IRS released a notice yesterday giving guidance on the PPP expense deductibility. They said while loan forgiveness was excluded from income per the CARES Act, this notice did confirm that the covered expenses related to loan forgiveness are not deductible, not deductible to the extent of the amount of the loan forgiven. Specifically, this notice clarified that no deduction is allowed under the Internal Revenue Code for an expense that is otherwise deductible if the payment of the expense results in forgiveness of a covered loan. This guidance ends many weeks of speculation on how the loan and related expenses will be treated for tax purposes. This treatment is consistent with prior IRS guidance, but many of us were hoping for an additional benefit due to the ongoing financial crisis. Unfortunately, this notice confirms, I think, what the IRS position was. It just clarified it on Thursday.
Yeah, but I'm not sure that this is, the IRS is the intent of Congress.
No.
So it's a
Stay tuned.
dynamic situation.
Yeah,
Like you said, stay tuned.
I would stay tuned and really talk to your CPAs and your attorneys, because this thing, as we know, changes.
It has been dynamic,
Yes.
I think those are good points, and this whole concept around the PPP has been a tremendous pillow, I think, to many businesses. But now all of a sudden we seem to have all this
More questions than.
postmortems and more questions than we used to. Well, anyway, thank you, David. Are there anything else? Any other questions that we've seen? Thank you, David, Michael, Matt, and Greg. Again, please tune us in next week at 12 o'clock. And our topic next week will be stock market returns in a presidential election year, and what does that mean for you? In the meantime, check out our website for other webinars that are occurring throughout the week, and be sure to look at our COVID-19 landing page. Thank you.